Welcome back to 7-Minute Options. I just noticed a pretty good position here in DKNG that I'm going to open. That's of course DraftKings. And if I look at the graph in DraftKings, I noticed that the IV is spiking. So the implied volatility right now is quite high. It hasn't been this high probably since February, and it's already starting to peak. So I want to take advantage of this one. I'm hoping for an implied volatility collapse over the next few days. So taking a look at the graph here, it bounced off the recent low, which was around $40. It went up, and then it's been going down for the previous 3 days before today. So, sorry, 4 days. It went down for 4 straight days, which of course helped push the volatility up. And then yesterday it moved up on huge volume, and then of course now with the big swings and the movements, volatility is spiking. But now today it actually saw very little movement today, and it's moving back up toward that line there, which is the 20-day moving average. So I think the downside move is pretty much done. It bounced pretty hard off the lower Bollinger Band there. It's moving back up now toward the moving average, probably going to cross it soon. So I think we've seen the worst of this down move, and I'm hoping for a quick move back up, which will also help collapse the IV quickly. So looking at this, I'm not too worried about the downside risk. I am definitely going to cap my upside risk. DraftKings tends to be one of those meme stocks where a lot of people tend to pile in. The Reddit crowd likes this stock as well, so I'm not comfortable holding undefined risk on the upside, but I'm okay with it on the downside. So if I take, let's say, the 40 put, and again, 40 is where it bounced recently, then I can probably, okay, that gives me about $68 right there. Okay, I'm coming up on end of day here. I got like 2 minutes before the market closes. Let's say if I take the 55.60 just outside the expected move, I got 134 bucks. This could really move up though, so I'm going to move it up a little bit further back, 60.65. So 60 on this graph puts me right about there, which is it hasn't reached that level probably since April. So you know what? There's a huge difference between the 40 and the 45. You can see there's 100 cents, like $1 difference between the two. So I'm going to move that to the 45, collect more premium. What if I move this out to the 65.70? So there I'm in the 8 delta range. Let's say, what if I go back to the 15 delta? There we go. So 45 naked put and the 60.65 call spread. So this is going to cost me $1,000 in buying power, but I'm going to get 5 theta for it. So that's like 200 bucks of buying power for each theta. I'm very happy with that. So let's see if I can get that filled in the next minute or two before market closes. And if as soon as it closes, I'm going to put in the GTC order to get about 30%. You know, why not more than 30 is because there's only 30 days left in this expiration cycle. And I only want to hold this for the next 10 to 15 days so I can exit. So I'm going to do this for a 15. Okay, that's the wrong position. Where are we? DraftKings. Okay, so now it failed. And I can always put my GTC in order even after market close. But there you go. I got 194 bucks for it. I'm going to close this position. And let's say I want to buy this back for 130. That would give me 60 bucks, which I think is fairly reasonable with the... Actually, I'm going to be a bit greedy here. I'm going to go for 120 because with that volatility coming down, I'm hoping to get there pretty quick. So that would give me 60 bucks on $190, which is roughly... Oh, there's the end of there's the closing bell. I made it. Good. Actually, so that's 77 bucks on 120. So that's more than 30%. So that's pretty good. Normally I would go for 30, but again, this huge spike in IV, now that it's starting to move back up a little bit, not a lot of movement today, I expect this to come down fairly quickly. And then, yeah, just to put the lines in where we are so we can visually see it. Our short strikes are the 45 and the 60. So going back here, price level at the 45, making that a bit thicker, 45, and putting another price level at the 60. Right there. And if this goes against me, my defense here is going to be so if this thing comes down to my naked short put, then I'm just going to roll this into the next monthly expiration. I have no earnings coming up, So I can probably roll this one, maybe even 2 monthly cycles and collect some good premium that way. Probably $100 each time I roll if the volatility is still high. And on the upside, I have a $5 defined risk credit spread. So that's I sold the $5 wide call credit spread. If that gets challenged, most likely I will not be able to roll it out unless I catch it early. So if it's just hovering around the $60 mark, and I can still roll out that credit spread to the next monthly cycle and get maybe like $10 or something. But the big gain there is going to be for me rolling up this put, rolling it out into the next monthly, and then rolling it up maybe like another $5 to the 50 strike or something. That should also help me collect maybe $80 to $100 in credit. But again, I'm looking to hold this for another 10 to 15 days, and around 15 days to expiration, we'll see if it's worth closing or rolling. Or hey, maybe if this thing goes sideways and the volatility crushes really quickly here, I can maybe get my $70 and close it out. So that's it. Thanks very much.